a few issues here. First of all, there is a structural headwind to the banking sector, in my opinion. You have to look at the rise of the fintech companies over the last few years. And the problem that the banks have is they have huge legacy assets, branches all over the country and indeed the world, that are relatively cost inefficient. Now, when you have the evolution of financial technology companies, and it's interesting, we have the Chinese fintech company Ant Financial waiting in the wings. These companies function by providing the goods and services at rapid speed over the internet, using the latest software and communications technology. And it's a very efficient way to enable customers to conduct their financial affairs. And they're branching out into originating loans and various other things as well. So that's a bit of a structural headwind for the sector. Having said that, the banks themselves, their share prices are trading at record low valuations on price to book value. There is a big kicker potentially to the share prices if the economy recovers more quickly than anticipated, because the bank's loan business will be very leveraged to a pickup in loan demand, and you should see better net interest margins as interest rates go up. Their loans will become more profitable. So you've got a sector trading at a very low rating, potentially very leveraged to an economic recovery and more loan profitability. So that's quite a big positive. So in the short term, a good economic outcome would be very good for the banks here. But I think we do have to keep an eye on some of these structural headwinds with the rise of the fintech sector as a longer-term issue affecting valuations.
So Nick, I think I might have misheard you a little bit, because I think the opportunities there as well. But you talk about the structural headwinds, and I think you've prefaced that with technology as well. I don't see it as a structural headwind necessarily. I see it as a stunning opportunity to cut bricks and mortar costs as well. And fintech and digitisation of the product offering as well is a stunning opportunity to not have the same level of, dare I say it, of personnel and indeed Main Street premises. So it's an opportunity rather than a headwind, yeah?
Yeah, it's an opportunity. I agree with that, but I would say, for the way I see it, it's banks being forced to catch up with the reality of the new internet-driven financial world. They're being forced to cut costs to keep up and become more cost-effective with their non-interest expense levels, which did spike quite rapidly as the pandemic took hold. In fact, if you look at the very onset of the pandemic, the banks had to spend a lot of money sanitising their branches, organising for their employees to work from home, and so forth. So there was actually a spike in costs there. But you are right. In the long term, there is an opportunity to streamline their businesses by closing branches. And I think you'll also see a lot of the smaller regional banks invest very heavily in financial technology to get their businesses more online. So there's going to be some investments needed there, and there are a lot of companies in the technology sector which provide the software and services to do that, which I think is very interesting going forward. You're definitely going to see banking move almost completely online over the next 10 to 15 years, in our opinion.